Okay, let's do some more comments. So here we have Hallister 53. We had a brief exchange here talking about a first lien HELOC, and he says, what about directing your entire income to a second lien HELOC to pay off high interest debt? Then once your debt is paid off, transfer smaller chunks like 10K or so from the second lien HELOC to pay down your mortgage. Yeah, you can do that. That works just fine. You can do velocity banking with a second lien HELOC. I think there are various different instruments you can use. And I'm not going to go through the full exchange that this guy and I had. It turns out he's a life insurance agent. So he's a fellow colleague of mine doing similar things to me. But yeah, I think the first lien HELOC takes the second lien HELOC strategy to its logical conclusion. The strategy is the same. It's velocity banking. That's the strategy, period. It's running your cash flow through a more efficient tool than a checking account. And you can use it as an example to optimize your debt payoff. So if you have debts that you're looking to pay off, that's where I think velocity banking can make the most sense. It's the most sort of no-brainer strategy. I still think it makes sense in other ways too. If you don't have debts to pay off, or if you have no toxic debt that you're eager to get out of, you can also use a HELOC to purchase assets, right? So it's flip sides of the same coin. You can use the velocity banking strategy to optimize your debt payoff. Once you've paid off your debts to the point that you're comfortable, then you can use that same debt instrument, whether it be a first lien HELOC, a second lien HELOC, whatever, to purchase assets. So yes, you can use a second lien HELOC. There's nothing wrong with it. I think the first lien HELOC has some advantages, especially automation, but there's nothing wrong with a second lien HELOC. There could be reasons to do it. Maybe you have a mortgage at a really low interest rate and you're just not willing to part with it. If you have enough equity, you could take out a second position HELOC. Sometimes people are not able to qualify for a first lien HELOC and you can use a second lien HELOC. So yeah, there are lots of different ways you could use it. If you want to pay off your mortgage, then using a second lien HELOC to make chunk payments to your mortgage can be helpful. Okay, and I don't want to go too deep into that. Just the point that I'm making is that the vehicle we're using is less important than the strategy. A lot of people go deep into HELOC versus mortgage, and to me, that's a distraction. Both are fine. There's nothing wrong with a 30-year mortgage. There's nothing wrong with a 15-year mortgage either. In fact, I think that for the average person, borrowing against your house, the way that you finance the purchase of your house, is going to be probably the most efficient form of debt that you can get access to. So the vehicle we're using is less important than the strategy we're using for it. So whether it be first position HELOC, second position HELOC, 30-year mortgage, 15-year mortgage, any of these can be fine. What's really more important is how are we utilizing it? Yeah, you can use a second lien HELOC. That's fine. You can have a 30-year mortgage. That's fine too. I'm not against mortgages. Mortgages are totally fine. If we're trying to pay off debts, mortgage will probably be the last one you'd want to pay off because it's a very efficient form of debt. You'd probably want to pay off other debts first, right? Okay. Here, Jolie 0208 says, awesome video. I'm currently doing velocity banking with a first lien HELOC and the results have been incredible. I don't understand the critics. Thank you for this video. Maybe people will listen and understand. Thank you, Jolie. I appreciate it. For whatever reason, most people don't listen. Maybe that's just social media. I don't know. But listening is a skill I've learned that very, very, very few people actually have. What they do is they pick out like one or two words or they have a knee jerk reaction and they don't really listen. So usually when I hear the critics, it's clear to me they haven't really listened to what we're saying. Or maybe they saw, because there are people out there, whether they're talking about velocity banking, infinite banking, any number of these strategies, there are certainly people out there who are doing it and promoting it in the wrong way. And so what they're probably doing is they see one of those videos or they see some of that content, and then they automatically assume that all of it, this whole swath of strategies are wrong. So anyone who's talking about velocity banking is wrong because they saw this one video that was promoting it in the wrong way. I think if people do listen, they're going to end up finding the truth one way or another. But most people do not listen, sadly. So thank you, Jolie, for being one of the few who actually listened in understood. And yeah, and again, it's good to see this because the results are real, right? There's nothing hypothetical about this. We're solving practical problems that you actually have, like helping you with your debt payoff. We're not talking about take some money, park it in a Wall Street jail like 401ks or mutual funds and hope for some return that may or may not materialize over the next 3 to 5 years. And in the meantime, you don't want to touch the money, right? Everything's hypothetical. There's risk involved, right? Gives you no cash flow. We're talking about things that actually are helping you in the near term and in the long term. So thank you for your comment. I appreciate it. I hope this person is doing infinite banking too, because I think I get engagement with the first lien HELOC and velocity banking because people can see the benefits more easily. Oh, I pay off my house faster. I pay off my debts faster. But in my opinion, infinite banking is more foundational and more important, although both are good and they're very complementary strategies. Okay, Kamisi Norwood says, "You two are rock stars." This is referring to me and DeAndre Clayton. Thank you, Kamisi. I hardly ever get positive comments like that, so I greatly appreciate it. So apparently we're not scam artists. Apparently we're not evil. It's interesting to me that that our critics have to bring in the moral dimension, right? It's like, wait a minute. I thought we were just disagreeing over a financial strategy. I didn't realize there was a moral dimension to this. You think financial strategy A is better. I think financial strategy B is better. Where's the moral dimension? I don't see any moral content in it, but it's interesting that when people attack us, they have to call us evil. It can't just be a disagreement over what the best financial strategy is. I think that says a lot more about our critics than it does about us. Okay, Michael Sparks is commenting on trademarking the infinite banking concept, a video I did with Stefan Kinsella, and he said interesting from a libertarian standpoint. Yeah, Stefan and I were talking about the problems, the challenges to trademarking in general, right? Intellectual property more generally, and specifically the Nelson Nash Institute trademarking the phrase, the infinite banking concept, and this idea that you can own words of the English language, that you can actually own words of the English language, infinite banking concept, and all of the problematic corollaries that come from. All right. And then Patrick Davenport also commented on trademarking the infinite banking concept and basically tells me, he says, get over it already. Come up with your own trademark. Okay. And then he says, Hazeltine IBC Designs. I guess that's his idea for what I could trademark. And then he says, with all the trash teaching out there, the NNI needs to protect the term IBC. They don't need a perversion of what Nelson discovered and muddying the waters. Thank you for your comment, Patrick. I agree with you. I do not disagree at all. I agree 100% with the Nelson Nash Institute on the infinite banking concept. I agree with them. I just don't agree with the methodology. So they do need to protect the term the infinite banking concept, yes, but that they don't need to do it by bullying other people and by using government violence to go after other people. That's where I have a problem. The best way to protect it is just keep promoting the truth, right? Don't use violence. Certainly don't go to the government for help. That's just going to make a bad situation worse. Okay. So I don't disagree at all with the Nelson Nash Institute. I just disagree with the methodology they're proposing, where they are playing this whack-a-mole game of attacking and beating up people using the government because I agree, they're misusing the infinite banking concept. I totally agree. And it doesn't reflect well on the rest of us when people do that. I agree. But there's a right and a wrong way to handle it. Okay, so I don't think the Nelson Nash Institute is going about it in the right way. But I agree with them 100% on what the infinite banking concept is and that we do need to protect it. I just don't think we should use government violence to do it. That's all. All right. So thank you for your comment, Patrick. I appreciate it. Okay. Kamisi Norwood gave another positive comment on another video. Greatly appreciated. Get Protected 3304 comments on my opportunity cost video. It says really nice part 1 and 2 explanation. Thanks. Thank you very much. I appreciate it. We'll keep trying to create this good content, which does take time and effort and skill. So I appreciate the kind words. Okay, here's Patrick Davenport commenting again. He's commenting on video on real estate investing and financial education, but his comment is really more related to other videos. So what he says is, wonder how many followers you lost degrading Nelson's writing and the cult members at the NNI. Degrading the man who discovered the concept you make a living off of was a trash move. None of us would know a thing about this concept if not for Mr. Nash. So the only thing you should be is grateful God revealed this concept to him. Too bad, because for the most part I enjoyed your content. Thank you for the comment, Patrick. I appreciate it. I think you're proving my point. Honestly, the way that you are responding to my content proves my point. That with some of the leadership and membership of the Nelson Nash Institute, it has become a bit of a cult in that we cannot have an honest discussion about this. It becomes a religious argument, and they get very shrill and very angry. And the sad thing is, again, I agree with them on the Nelson Nash Institute, and I think it's very counterproductive and turns people off when they see people turning what is a brilliant financial strategy into a form of religion, which is not what it is. But I appreciate the commenting, and I'm open to a conversation on this. I have invited members of the Nelson Nash Institute to discuss it if they want. Up to them. Because again, we really agree in general. It's just a question of what's the right methodology for promoting the infinite banking concept. And then, yeah, so we had a brief exchange there. But again, thank you for commenting, Patrick. I don't think we disagree on much. I think it's just a question of what's the best methodology for promoting the infinite banking concept, really is what it boils down to. Okay, and then we have, this was from my video on infinite banking is a scam, whole life insurance is evil. I had fun creating that one. I was caricaturing our critics. What's interesting is getting back to what I said earlier about people not listening. The sad thing is there were people who saw this title and assumed that I'm attacking whole life insurance and infinite banking. They won't take more than the 3 seconds to actually look into it and find out, oh, I'm actually promoting the infinite banking concept, and this title is obviously sarcasm. It's obviously a caricature. But those are people I cannot help. If you're not willing to listen for more than 3 seconds, then there's really not much I can do for you. So the Wealth Warehouse podcast, I believe, is another infinite banking podcast. Thank you for the kind words. Appreciate it. He says good stuff. And I'll go into our exchange here because I think it was interesting. So I said, thanks. Did you have a favorite of any of these standard criticisms, or do you have one to add? And the Wealth Warehouse podcast responds, Hazeltine LLC, you pretty much nailed it. What's funny is that the buy term and invest people always compare gains you could have gotten in the market, which is comparing apples to bananas. They don't understand what IBC is all about and don't see how we're using the policies to mainly acquire assets that cash flow. We're in total control. They also don't get how the loan is the best possible loan out there. I could go on and on, but that's something. Thanks for commenting, Wealth Warehouse podcast. I appreciate that. Yeah, I agree with him. I don't have much to add, but my response was, thanks for the compliment. Yes, I agree. Buy term and invest the difference could be a whole episode. What's interesting is that if you take the logic of buy term and invest the difference to its conclusion, you shouldn't even buy term. In fact, you shouldn't buy any insurance, just invest the whole pile. And the Wealth Warehouse podcast responds, exactly. The whole self-insured thing just means going without insurance, which is like saying, I'd rather spend own money on emergencies. They don't go without car, health, or home insurance, but when it comes to the only guarantee, death, they choose to take their chances. It's the funniest thing. Yeah, I agree. It is funny. It's also tragic when it comes to the consequences. I mean, we laugh, and that's all you can do. But when you see what it does to poor widows, I mean, it's tragic when you see the results of so-called buy term and invest the difference. But again, if you take the logic of buy term and invest the difference to its conclusion, like I said, you should never have any insurance. When we talk about these supposed gains in the market, yeah, you could get them. You could make good money in the market. The problem is it's all hypothetical. And they state it like it's dogma, like you will get 8 to 12% if you put your money in quote unquote the market. And they never specify what they mean by that, because it's like, okay, well, I could buy an S&P 500 index fund. I could buy a basket of mutual funds, right? There's a lot of different ways I could deploy my capital in quote unquote the market, which is not a market. It's a Wall Street casino, but whatever. Let's say the S&P 500, right? Let's say I buy an S&P 500 index fund. Yeah, it's possible it could go up 8 to 12% per year on average. And I could look at historicals and maybe see that historically that's about what has happened. But there are no guarantees. And again, they state it like it's dogma, like it's a fact, like you will get 8 to 12% returns. Well, how do you know? How do you know? I mean, you might or you might not. And what they're really saying is you should gamble your entire retirement savings on that premise, right? When you look at the fact that people are pretty much putting all of their retirement so-called savings into 401ks and mutual funds, what they're really doing is gambling their entire retirement on that premise, which is why a lot of them are very nervous about retirement, even though they may have built up a substantial nest egg, because it's all at risk. It's all at risk. So for me, it's just not worth the risk. I'm not saying it cannot work. Certainly it can, but I would say it's just not worth the risk. I'll take the guaranteed result, not the hypothetical result. And if those people put their money in the market and it does better than me, I'll pat them on the back and say, congratulations. I'm glad it worked out for you. It was too much risk for me, but happy it worked out for you. Okay. PKP 2023 is commenting on my first lien HELOC video saying if the remaining balance is X at 2.345% 15-year mortgage, then in this case and with today's HELOC rates of 8%, is it applicable? Please let me know. And of course, the answer is it depends, right? He's talking about his specific situation. So apparently this person got a very low 15-year mortgage at a 2.345% interest rate. That obviously is very low. That's low by historical standards. So does it make sense for someone like that to refinance their 15-year mortgage into a first lien HELOC? Well, it depends. We'd have to look at it. It would depend a lot on your cash flow situation. And there's nothing wrong with keeping your mortgage either, right? A lot of it comes down to not just cash flow, but psychology as well. So yeah, that's a great, very low interest rate. Maybe you should keep it. I don't know. We would have to talk about it. So the answer to any good question is it depends. So the answer, of course, is it depends. We could run the numbers, and if you have enough positive cash flow, we could see that it might make sense. But even then, just because the numbers say it could work doesn't mean you should do it. There's a psychological element to it as well. There are other things to consider. So thank you for commenting. Appreciate it. Matt Seibert comments on our video we did together. Thanks for having me on. Always a fun time talking about agency building. Thanks, Matt. Appreciate your engagement. Thanks for coming on the show as well. I hope we can do more videos in the future about what it takes to succeed in the life insurance business. And I'm certainly no expert on that. I'm nowhere near where I would like to be. But Matt does a lot of training of agents. He's got a lot of experience and some interesting insights on how you succeed in the life insurance business. The good news is there's no one right or wrong way to succeed. Thanks, Matt, for commenting, and thanks for coming on the show. Appreciate it. Okay, an actual space shuttle 7656 comments. Wish you'd explain how that works because this video didn't make that clear. So he's commenting on the opportunity cost video. And I responded to him. I didn't get a response back. What could I make more clear? Please let me know. I'd be happy to clarify it. But that first video was just an introduction, obviously. I wasn't going into everything. So how that works, I don't know what he's referring to. But again, that video, there ended up being 3 of them. That was just the first one. And it was really just intended to introduce the concept, not go into great detail how it works. So hopefully videos 2 and 3 help to clarify that. But if not, let me know what wasn't clear. I'd be happy to clarify it. But yeah, again, the reason why I thought it was important to do videos on opportunity costs is because that is the problem we're solving with the infinite banking concept. And it's an invisible problem, the problem of opportunity cost, problem that most people don't realize they have. And that's part of what makes the infinite banking concept difficult to explain is because we're solving an invisible problem. And this is why the fact that, so you could pay cash for something. If you borrow against your whole life policy instead and use a policy loan, there's interest charged on that policy. And I would argue the fact that you can now see the interest being charged is actually a good thing relative to paying cash. Because if you pay cash, you're still paying interest. You gave up the interest you could have earned on that cash. The difference is you cannot see that hidden opportunity cost. Whereas when you borrow against your whole life policy, you can see the interest you're being charged. And that's good because if we can see a problem, we can address it. But if we cannot see it, it's very difficult to address it. Okay, so Michael Sparks comments again. This is on my Nelson Nash Institute videos. He says, interesting. I guess I need to go back and view part one. You have some really valid points in your conversation. Wish I could have seen the entire discourse. Thanks for commenting, Michael. Appreciate that. And then he commented further and said, just finished part one. Good stuff. You're right about the ability to explain IBC. The marketers that are successful are just good marketers, and one which I'm not. And don't get me started on the hundreds of books written by agents, just reiterating the initial points. Yeah. Thanks for commenting, Michael. I appreciate it. Seems like we agree on this, so thanks for engaging. Devil Wilson, 7099, comments, solid information. Thank you. Thank you, Devil. Appreciate you commenting on and engaging with my content. This is on my series with DeAndre Clayton on answering objections to the first lien HELOC and velocity banking concept, which we were actually really responding to comments like I'm doing now, but we were responding to a couple of specific commenters who commented voluminously. And thank you for commenting. They provided us with a lot of content to respond to, so we appreciate that. It was great to use it as a teaching moment to answer some of the standard objections that we oftentimes get. And again, I think a lot of the standard objections come down to either a misunderstanding of the concept or narrowly focusing on the vehicle and missing the strategy. So they'll get down into HELOC versus mortgage and they'll start running numbers, which is, to me, that's missing the point when you do HELOC versus mortgage. Running the numbers can be helpful, but the numbers are not everything. There's more to it than just the numbers, right? Because we're not robots, right? We're not robots. If we were robots, then the numbers would be all that was necessary, but we are not robots. We have human psychology, we have emotions, we have unknowns in our life, and we want to develop a strategy that accounts for all. So it's just the numbers. I like to compare financial fitness to physical fitness. And obviously, in both financial fitness and physical fitness, the most important element is human psychology. In both cases, you can come up with a plan that makes sense from a numerical standpoint, but really the challenge is more about your ability to execute on the plan. And there's no one right or wrong plan in the abstract. It really depends on you. Mortgage could be great. Mortgage might be better than a HELOC for some people. I have nothing against mortgages. Okay, Better Wealth comments. Thanks for sharing your perspective on this, Logan. I think there are some important ideas here and some conversations that need to come from this. Thanks. This is Caleb Gilliams from Better Wealth. Thank you, Caleb, for coming on the show. Greatly appreciate it. So this was I interviewed Caleb, and then as a follow-up to our interview, I created a couple of videos examining or broadening some of the discussions that we had with regard to the Nelson Nash Institute specifically, and how do we best promote the infinite banking concept. So Caleb, thank you for coming on the show. I really appreciate that. Okay. Double Check It YT says, it sounds like you're saying the $6,000 premium increases by the $55,000 in the same year, but looks more like the chart shows that it increases to $55,000 in that year. 6,000 times 45 equals $270,000, doesn't it? I'm sure I'm just missing something, so please don't take this as naysaying. Thank you for your comments. Double Check It. I'm certainly not taking it as naysaying, so thank you. I appreciate it. It's an important clarification. In this video here, some people misinterpreted the chart. I'm not going to click on the video, but the visual here, which you can see, is this exponential curve. And I think the natural assumption some people made is they assumed the numbers I'm showing in the chart are the total cash value of the policy. But that's not what I'm showing. What I'm showing is the year-over-year increase in the cash value each year. So it doesn't increase to $55,000. It increases by $55,000. So again, I respond, the chart shows the year-over-year increase in cash value. The total cash value is not shown. So again, I'm just trying to show one variable at a time so as to not lose people. And I think multiple people misinterpreted that. What I'm trying to show is the cash flow efficiency in whole life, right? That's what I'm trying to show. So the total cash value and the total death benefit are not shown in the chart. Just showing how much does your cash value increase each year. That's what I'm trying to show, the cash flow efficiency. So if you deposit $6,000 into your bank account and your account balance grows by $55,000, doesn't that sound like a pretty good deal to you? That's kind of what we're doing here. And once you get towards the later years in the whole life policy, you have that kind of efficiency, right? So thank you for your comment. It's good clarification. I might go back and do another video on that. It's hard to show everything in once. So I'm just focused on the cash flow efficiency. Astroman30 comments on our video, Infinite Banking is a scam, whole life insurance is evil. He says, I only watched the first 30 seconds of your video and I absolutely agree with you. Next. I had to give him credit. I was like, look, if you watch the first 30 seconds, you're doing better than most people. That is for sure. So thanks for watching. Thanks for commenting. And then Dakota Dak responds, and we had an interesting exchange here. Dakota Dak, as it turns out, is actually a life insurance actuary. We had an interesting exchange here. He says, hello, Astroman. I see you are a critic of permanent life insurance. However, let me ask a question to see if you understand how it works. How is the amount of a policy's cash value determined? If you don't know how, then why should we listen to your opinions? We went into that. I don't want to go into the whole exchange here, but it was interesting. I'm glad. Thank you, Dakota, for commenting, by the way. Thank you for commenting. I'm flattered I have a life insurance actuary who listens to my channel. I always appreciate the commenting. Feel free to engage anytime. And then Wealth Warehouse points out that Astroman is against the infinite banking concepts and whole life insurance, which, yeah, I can see that, but that's fine. Keep commenting, Mr. Astroman. Happy to have the engagement. We can continue having a conversation. Okay, so here on going to my Do What the Rockefellers Do videos, this is talking about, again, the cash flow efficiency in whole life. So Pavel Kodolka, I'm sorry if I'm not pronouncing that correctly, but Pavel Kodolka, 8934 says, do you have the impression paying 10 years of money into an empty hole is effective? What on earth are you smoking? If he invested that money in an ETF or a good fund, I'd be at 300,000 after 20 years, not 85. If I did it for 85 years, I'd have 200 million at the end. So this amazing offer only sets you up by less than $200 million in your lifetime. This has to be the worst offer in the history of offers. Anyone who even offers this to a customer should immediately lose at least 2 fingers. So this, goes to the way that our critics, unfortunately, oftentimes behave, which is inciting violence in this example, suggesting that I should be subjected to a pretty disturbing form of torture because of what I'm doing. So apparently I'm on that level. But again, he's obviously misunderstanding what we're seeing, right? So I don't think it's ever a good idea to assume that people are idiots, right? If I see another financial strategy and it appears to be insane on the surface, I don't assume that other person is an idiot. I assume I'm probably misunderstanding something. And so I dig a little further, and invariably I find out, oh, okay, yeah, the financial strategy actually does make sense in certain circumstances. I just didn't quite understand what they were saying. So instead of assuming that I'm, suggesting that you basically put money into an empty hole, maybe try and dig a little further and try and understand what I'm actually saying. So as I mentioned before, the problem is he thinks that the chart is showing the total cash value you have in the policy, which is not what it's showing. It's showing the cash flow efficiency, meaning the year-over-year cash value growth. I go into that. So I said, basically, but you're missing the point by focusing on how much money we accumulate. The point here is the cash flow efficiency in whole life. In this whole life example, the 45-year-old pays $1 premium into his policy and his balance rises by more than $9. And then Mr. Pavel responds again, can you even count? Paying $500 for 85 years means I'll pay $510,000 and end up with $300,000. So I'd literally be better off if I shoved that money under my mattress. Wow, that's thick. I know exactly how much less I'll get and it's worth it. And we're not even talking about inflation, and that the money at that time will have a fraction of its original value. Brilliant product. Those who sell it and profit from it. People like you cut off their hands in the Middle Ages. They should consider reintroducing these habits. So once again, he's assuming that I'm actually suggesting that someone should pay in $510,000 to a vehicle and have only 300,000. Now, if that really were the case, that would be pretty dumb, right? You just hold the cash instead. But instead of assuming that the other person is an idiot and the financial strategy is idiocy, maybe instead saying, probably it's that I'm not understanding, right? I never assume other people are idiots. I don't think other people are dumb at all. I never assume other financial strategies are idiocy. Usually the problem is if it looks dumb, it's because I'm not understanding something, right? So I don't think we should assume other people are idiots, right? We need to dig a little deeper. And of course, what you find is that actually that's not what's happening. And of course, again, our critics have to incite violence, right? So he's suggesting that I should have my hands cut off. Well, I think that says a lot more about our critics than it does about us. I'm not in favor of violence. This person apparently is. So again, it's very simple. You're misreading the chart. The numbers given are the year over year increase in cash value, not the total cash value. So at age 80, the total cash value, which is not shown, would be $6.2 million with a death benefit of $7.9 million. So if I did pay in 510,000, which I'm not sure if his arithmetic is correct, I'll assume that it is. So I paid in $510,000 and I now have $6.2 million in cash value and a death benefit of $7.9 million. All of that was done without paying any taxes or taking on any market risk. That sounds like a pretty decent deal to me, especially when you consider the creditor protection, the long-term care protection, the other benefits that come with whole life insurance. So again, when you assume that someone else is an idiot or that a financial strategy is idiocy, it says a lot more about you than it does about the other person, right? Pretty much every financial strategy out there, or pretty much every idea out there, it's generally not that people are idiots, right? That's usually not what's going on. So I don't ever assume other people are idiots. I certainly don't assume that they're evil. I assume nothing about their motives. We can have a disagreement about what the best financial strategy is. And there's no one right answer either. A lot of it depends upon you. So let's not jump to the conclusion that someone else is a moron and their financial strategy is idiocy just because I cannot understand it. The problem is I'm making myself the principle of judgment and I'm doing it without really taking the time to investigate that particular strategy, right? So oftentimes I personally will dismiss other strategies, but I won't say they're dumb. I'll just say, look, I don't have the time to investigate. An open mind is like an open mouth, like G.K. Chesterton says. It only exists until it latches onto something solid. So I know I have something solid with the infinite banking concept and the other strategies I propose. I'm not saying all of their financial strategies are dumb. I'm not saying that at all. Generally speaking, I'm just saying I'm not going to take the time to investigate. I have something that I know works and works with very little risk. So all of that is a long-winded way of saying, obviously, he's just misreading the chart. If he would pay a little more attention, he would see that we're not talking about the total cash value in this chart. That's not what's depicted. What's depicted is the year-over-year cash value growth. Once you understand that, then you see the cash flow efficiency in whole life insurance is incredible. And in particular, I'm showing what happens when you take out a policy on a juvenile, on a newborn in this case. And it's phenomenal because the most important element in whole life insurance is the passage of time. It ages like a fine wine. So thank you for commenting, Pavel. I'm not sure if I'm pronouncing your name correctly, but thank you for commenting. Appreciate the engagement. And we'll keep responding to these comments as I have time.